from the inception of FICE, it has been evolving over time. Now, the initial requirement was quite not less onerous, and it only required an FSP to hold assets that are at least equal to liabilities, and it did not have further other requirements, save for the requirements that goodwill was not considered in the calculation of the financial soundness. Safe to say that, but we had quite a lot of issues and queries about this matter, and which kept us busy at the time trying to explain that to the respective FSPs. Now, as you know, that FSCA, which was and its previous predecessor, FSB, as regulators are subject to review by the international standard setting bodies. In 2014, there was a review by the FSEP reviewing all our legislative that we administer, and which included the FICE. What they've identified was that we need to rather reinforce our financial soundness requirements in order for us to ensure that the clients are protected. And some of the issues that came out of that was the issue of the early warning and the liquidity requirements. That resulted in the amendments of the Act. As you know, in 2018, prior to that, there were further stricter financial soundness requirements in terms of liquidity and all and the other. And subsequent to that, of course, we were faced with a huge number of FSPs that had problems in reaching out or in reaching or attaining these requirements. And we've been involved ever since with the issue of processing exemptions from the affected FSPs. Now, the issue was more exacerbated again by the lockdowns that we have experienced in the past 2 years since 2020, and that affected a lot of FSPs. And we sat down and realized, what can we do? And one of the other issues that we identified was that most FSPs struggle to understand this concept and especially how we calculated the solvency. And it is in that regard that we felt that it would be important that we run such workshops to take through the FSPs through how we do the calculation of various financial soundness irrespective of different categories of FSPs. Hence, it is our view that following this workshop, there will be a better understanding of how we determine financial soundness. That is in brief what I wanted to say, and I hand over to you, Zinhle. Take over the process.
Thank you so much, Mr. Malimabe, for the warm welcome and for framing the conversation of the day so impeccably. The presenters for the day are Mr. Thobekani Hlatswayo, Ms. Nobantu Mkhwanazi, and Ms. Ziyanda Brukwe. I would like to take this opportunity to tackle the house rules before we proceed. All the mics have been muted for the duration of the workshop. This session is recorded and it will be posted on our FSCA YouTube channel. The speakers will present, then we'll open the floor for questions. You are welcome to pose your questions relating to the slides in the chat box during each presentation, and our esteemed colleagues will respond to your questions on that forum. We will also respond to some of your questions in the chat box verbally once the floor is open for questions and answers. Please raise your hand in the reaction section of the Microsoft Teams, and your mics will be enabled for you to ask your question or to share your comment. Please note that there may be a lag in the mic enablement. Please bear with us when this happens. In the event that your mic does not work at all, please pause your question in the chat box and we will answer you. Please note that we will afford you a 5 to 10 minutes break after an hour, but then it will depend on how the presentation goes. Just before I hand over to my colleague, it is imperative that we consider what the purpose of compiling financial statement is. This will assist us in framing the amount and quality of information that needs to be included in the financial statements in order for them to be effective. The purpose of the financial statements is to provide information about the results of operations, financial position, cash flows, and changes in equity of the FSP at the end of each financial year. Financial statements afford the FSP the opportunity to take stock of how it has performed during the financial year and whether the performance is aligned with its expansion strategies. This information will assist you in making decisions regarding the allocation of resources for future periods. It is also an opportunity to analyze the FSP's financial health and whether the FSP is operating as a business that is economically solvent. It is essential that the annual financial statements are well structured, understandable, informative, and comparable to those of your sectorial and industry peers. The annual financial statements must be compiled in accordance with the applicable accounting standards and must meet all the regulatory requirements that apply to the financial services provider. I will now hand over to my colleague who will unpack the applicability of the legislation and submission requirements. Over to you, Mr. Hlatswayo. Thank you so much.
Thank you, Zinhle. I'd like to convey my warm welcomes to everyone who made themselves available for today's session. We know that you guys are busy and we appreciate the time that you're taking. I'd like to welcome you all to the financial submissions for financial soundness workshop for financial institutions that do not collect or hold client funds. My name is Thobekani Hlatswayo. I am an analyst within the phase department under the COB division, which is then the conduct of business supervision. Thank you again for joining us today. Akashan, can you please move to the next slide? Thank you. What mainly I'll be focusing on is the legislation and its applicability. The two main pieces of legislation that we'll be focusing on today. The two main pieces of legislation that we'll be focusing on today is the Financial Advisors and Intermediary Services Act 37 of 2002, more specifically focusing on Section 19, Board Notice 194 of 2017, otherwise known as the Determination of Fit and Proper, as amended by Board Notice 707 of 2020. More specifically, we'll be focusing on Chapter 6, which relates to Section 43 to 45. Next, we'll be focusing on Phase Board Notice 82 of 2015, which specifically looks at the Annexure A. The applicability of these sections is that they apply to all financial services providers, juristic representatives of those financial services providers, but they do not apply to key individuals and representatives who are natural persons or FSPs that are registered as banks or insurers. Can you please take us to the next slide, Akasha? Thank you. So the general requirements for submission. So as you guys know, all FSPs need to make submissions annually. So this is basically for every year. And these submissions need to be made no later than 4 months after the financial year end. So for example, if an FSP's financial year end is the 28th of February, the submission will be expected to be made to the authority latest by the 30th of June of that specific year, and so on and so forth based on the financial year end. These financial statements that are submitted need to be approved and signed by the directors and members or the specific sole proprietor. In the instance of a closed corporation, they need to be signed and approved by a minimum of 50% of its members. So in an instance where an FSP feels that they won't be able to meet the submission deadline of 4 months post their financial year end, FSPs have at their disposal to apply for an extension. So the requirements for an extension is that the FSP needs to submit sound reasoning for the application of the extension, and this submission needs to be made 15 days before the financial year end. So this would be 15 days before the 30th of June for an FSP whose financial year end is the 28th of February. And then this will also need to be submitted then by a cash payment of 650 Rand, which is currently, and this will then be submitted to FaceFin, to the FaceFin email where you guys submit your financial statements. And it must be noted that applying for an extension doesn't necessarily mean that it will be granted, but the granting of this extension is left to the discretion of the authority. Let's just hold on. Just in another instance, we've also noticed that some FSPs do get their license and unfortunately do not operate for a specific financial year. And in those instances, FSPs are also encouraged to submit a dormancy letter. This letter is to come from the FSP's accountants supporting the claim that the FSP hasn't been operational during that specific year. And this is also to be submitted within that same period of 4 months post the financial year end. Because FSPs do find themselves in some trouble and catch themselves in a batch of suspension for these types of issues. So if you guys can also note that. Thank you, Akash, and can move to the next slide. Next, we'll be looking at the financial statement submission requirements. So we also, FSPs are required to submit a full set of financials. So a full set of financials should include a balance sheet, which will then give us an indication of the financial position of the FSP, giving us exposure to assets, all its liabilities, and owner's equity. The next is the income statement. So the income statement will give us a brief view of how the profitability of the FSP is looking by outlining all of its income or revenue generated against its expenses. Next is the cash flow statement. So this basically just looks at all the cash operations of the FSP, and this gives us a better look at the liquidity of the specific FSP. The statement of changes in equity, this then gives us an underlying view of how the equity of the FSP is situated and looking. Next is notes. So in any instance, when you just have numbers on any financial statement, it doesn't give us any direction as to exactly what's happening. So notes are very important that FSPs do include them because it then gives us a brief background on exactly what's happening to the figures and what's technically happening to the FSP. And this then gives us directive in order to how we need to analyze them. This then will speak to the depreciation cycle used by the FSP, the interest charged on loans, and so on and so forth. Next will be comparatives. This is very important. We've noticed that some FSPs do not include comparatives in their figures, and this then does create an issue regarding the reliability of the financial statements because we are not able to see any trends that might have sparked off or catch you guys on any of the issues that we might see that might be problematic moving forward. So FSPs are encouraged to include reference figures for the previous financial year on the new financial year. And then in the instance that would all of these need to be included, these then need to also be followed by a director's or members report. This will then basically be signing off on the financials that the members do know what's going on. Next, if the financials are audited, they'll then need to be accompanied by a Section 19.2 auditor's report. Please note that these are for audited financial statements. In an instance where the financial statements are not audited, they'll need to be accompanied by an accounting officer / independent reviewer's report and an Annexure A. Most importantly, that you guys need to note is that the Annexure A needs to be signed by the key individual of the FSP. The key individual, not the directors, not anyone else, but the key individual. So in an instance where the financials are submitted and the Annexure is submitted and they're not signed off by the key individual, the financials are considered to be non-submitted. And at that moment, we do not rely on them, and the FSP needs to remedy that swiftly. Thank you very much for all of your time. And I hope that you guys did note down your questions. And then we will see you guys once you have the answer and question session. I will hand over to Nobantu to handle the rest of the presentation. Thank you.
Just before we hand over to Nobantu, I would like to make a correction here. Our extension fee is 605 Rand. Currently, it is not 650, it is 605 Rand. Thank you so much. Over to you, Nobantu.
Thank you so much, Zinhle, and thank you so much, Thobekani. My name is Nobantu Mkhwanazi. I'm an analyst in financial advisory, in financial advisors and intermediaries department under the COB Conduct of Business. Firstly, I would like to welcome everyone who managed to join us today. I know we all have a busy schedule, but you've managed to schedule some time to come and spend some time with us. I really, really appreciate your time and your efforts to join us in this workshop. So on this slide, I will be taking you through the financial statement submission for sole proprietors FSP in terms of the Section 19 of the FACE Act. So the general requirement for the sole proprietor's FSP is that the financial statement must be submitted on an annual basis. When we mean on it, it means that on a yearly basis, the financial statement must be submitted to the authorities, not after 2 years, not after 3 years, but on an annual basis. And those statements must not be later than 4 months after its year end. So let me just give you an example, like my colleagues just mentioned earlier on. So if your financial year end is 28 February, so your financial statement will be due on the 30th of June for that particular year. And those financial statements must be approved and signed by the owner. So the owner, which is the sole proprietor, is the one who is responsible for ensuring that those financial statements are approved and signed. And the other thing as well is that the full financial statement of the sole proprietor must include the following, which is the balance sheet. The balance sheet will give us an overview of the financial position of the FSP for the particular year. And this balance sheet will also include, on this balance sheet, it will indicate the assets, the liabilities, as well as the equity of the sole proprietor. And we'll also have to submit an income statement. An income statement also it also provide us with the financial performance of the FSP for that particular year. So it means that it will give us an indication of the income that the FSP managed to generate during that particular year. It will also give us the expenses that they've managed to incur during that year. So the difference between the two, it will also give us an indication whether the FSP managed to generate profit at the end of the financial year. And those financial statements as well must be accompanied by Annexure A of the Phase Notice 82 of 2015. We also have, the FSC also has a template in place that the sole proprietors might be able to use to compile their financial statement. That documents, or the template, it's a guide that will assist the sole proprietors to be able to compile their financial statements. And on that guidance as well, there's also a template that the sole props can be able to use in order to prepare their financial statement. And that template is also acceptable as the financial statement for the sole proprietors. And please bear in mind that that template, it needs to be signed before you submit it to the FSCA. It needs to be signed and approved by the sole proprietor. Thank you so much, Akash, and we can move to the next slide. As I've mentioned on my slide, my previous slide, we've mentioned that the FSPs are required to submit Annexure A together with the financial statement. So what I'm going to be doing at the moment, I will be taking you through the Annexure A, just trying to unpack it, because we've experienced during the analysis, maybe when we analyze the financial statement, we noted that some of the FSP are still struggling to complete the Annexure A. So I just want us to go through that so that we can be able to educate each other, so that they'll be able to submit to complete the Annexure A. Can you please take me through to the link?
Hi, good morning, everybody. Before Nobantu takes you through the Annexure A, we also get lots of queries from the FSPs wanting to know where to find Annexure A on the website. So I will take you through to the website to show you where you can find it. So on our homepage of the website, you will go to Regulatory Framework. You'll go to notices. Then you will go to phase notices. And then you look for 2015. You look for 2015, you click on the plus sign, and then you'll scroll down. There's a little arrow there. You'll click on that one and you'll carry on until you get to this page, and you'll find phase notice 82 of 2015. That's where you find it on the website. So I'll open it, and then Nobantu will take you through it. Thank you.
Thank you so much, Akashin. Okay, no, thank you so much, Akashin. This is Annexure A, and I'm sure most of you guys are aware of these documents because normally it's submitted every year with the financial. Sorry about that. Okay, as I was saying earlier on, it's just that I believe that most of the FSPs are aware of this document, which is an Annexure A. It's one of those documents that it's one of those. I'm sorry about that. My camera was off. I'm sorry about that. As I was saying, that I believe that most of the FSPs are aware of Annexure A. It's one of those documents that they submit on a yearly basis with the financial statement. However, we still have a challenge with some of the FSPs who don't submit these documents together with the financial statement. So this is the Annexure A. So basically, the FSPs are required to submit audited financial statement. However, there's an exemption for FSPs. They are granted an exemption not to submit Annexure A. So we talk about those FSPs where the financial statement are independently prepared, and those ones where there's financial statements are independently reviewed. So those FSPs are exempted from submitting audited financial statements. So if you are exempted from submitting audited financial statement, then you will have to submit Annexure A together with the financial statement on a yearly basis. So basically, we'll go through the exemption. So this is the documents wherein you'll complete the name of the FSP, the FSP number, and then we'll go down with there will be some the definition as well of the exemption. So in terms of number, I just wanted to highlight this on point 3. It says a provider must annually, in addition and simultaneously with its financial statement, submit the return to the register in order for the exemption to be applicable. So please bear in mind that if you don't submit this document, then the exemption falls off. Then you will be required to submit the audited financial statement. So in terms of point number 4, we have categories of exemptions. We have 2 types of categories for FSPs. We have the eligible FSPs, which means is those FSPs who do not receive or hold premium as contemplated in the Short-Term Insurance Act of 1998 and the Long-Term Insurance Act of 1998, or otherwise receive or hold clients' money or other asset. And then we also have another category that falls within that, which is an eligible FSP limited by product. So this one, it means a category 1 FSP, which is authorized to render financial services in respect of financial product belonging to a long-term insurance subcategory A or friendly societies benefit only and when they receive or hold premiums as contemplated in the Long-Term Insurance Act. So if you follow, there's one thing that I've also picked up, that when the FSP complete this form, some of them, they will complete, they will tick both boxes. So you cannot be an FSP that collect and FSP that doesn't collect at the same time. So you must be in a position to collect, to tick the box that is applicable to your FSP. Can we move to? Okay, there's also the criteria for exemption applicable to this one. So if you've selected 4.1 on the exemption criteria, then this box, this one is applicable to you. It's applicable to FSP who are eligible FSPs. So in that, it will ask a question: is the provider authorized as a category FSP, category 1 FSP? Then you will answer yes. And then does the provider receive or hold premiums? If you do not, does the provider receive, sorry about that, does the provider receive or hold premium as contemplated short-term insurance or long-term? Then if you selected the first criteria as an eligible FSP, then you will select you will have to complete this this form. And then if you selected an FSP eligible by product, then you will have to complete this table B. But for the purpose of this, workshop, we do not have FSP that collect premiums. So with regards to point 6, the general, so the FSP will have to select what is applicable to them. So this question, it says, is the provider required by any other law to have its financial statement audited, independently reviewed, or otherwise reported? If that's the case, then if it is applicable to the FSP, you say yes. If it's not applicable to the FSP, you select no. But it says there that if you've selected A, if you selected yes in paragraph 6.1, then you'll have to state in terms of which provider must submit such financial statement. And then if you selected if you answer to the question in paragraph 6.1 is yes, then you'll have to indicate whether the following statement must be audited, reviewed by an independent accounting officer and other. So please bear in mind that the exemption does not apply where the provider is required to have its financial statement audited. So even here on point number 6.4, it says that is the provider required. Sorry, Ashkashin, it's like you moved a bit. Oh, okay. All right. Okay, thank you, Akashin. So even this one, it says if the answer to 6.1, okay, we've passed that one. So, and 6.4, it says, is the provider required by an agreement in terms of which the provider is a party to cause its financial statement to be audited and reported? If the answer is yes, then the exemption does no longer apply. So on this one, we go to section 7. The section 7 is only applicable to providers who operate as a company or a closed corporation. So even there, on section 7.1, you will indicate the type of a company it's operating, whether it's a profit company, a profit CC, a non-profit company, a non-profit CC, external company. So the FSP will select what is applicable to them. And then the 7.2, it also says if it's a profit company, please indicate the type of a profit company or a CC. Then the FSP will also select what is applicable to them. So please bear in mind that the exemption does not apply if the provider is a state-owned company or a state-owned CC or a public company. So if a non-profit company or a CC, if a non-profit company or CC, please indicate whether the company or a CC was incorporated. So you'll have to select there whether it was directly or indirectly by the state, an organ of state, a state-owned company, an international entity, a foreign entity, and a foreign company. And you also select there if it's applicable, whether it's a primarily to perform a statutory or regulatory function in terms. We can move over to another section, Akashi. So as we have mentioned before, if the above that I've just mentioned now is applicable to the provider, then the exemption does not apply. So in terms of section 4, is the company a CC? It's asks if it is the company a CC or a company or a CC in the bracket profit or non-profit required by its memorandum of incorporation, a founding statement, a shareholder/members resolution, a determination by the company or board /CC members of the company to have its financial statement audited. If that's the case, then the FSP will select what is applicable to them. And if the answer to the above question is yes, then the exemption doesn't apply. It also to number 7.5, it says you must indicate whether the FSP is a CC or it's a company or a CC, profit or non-profit in the ordinary course of its primary activities, hold assets in a fiduciary capacity for persons who not related to the company, and the aggregate value of such asset held in any time during the financial year exceed 5 million. Then if you select yes, then you must know that the exemption does no longer apply. So we're going to come into a very interesting topic, which is a public interest score. So it is a requirement for the companies and the close corporation to calculate their public score on a yearly basis. So please bear in mind that the FSPs who operate as sole props are not required to complete this section. It's only for companies and close corporations. So the public interest score, so the FSP will have to calculate their public interest score on a yearly basis. So in terms of 8.1, you will have to provide the public interest score. So once you have calculated your score on section 8.2, then you have to indicate your score under section 8.1. So the calculation of public interest score is calculated as follows. So the providers must calculate its public interest score by completing the table below. Every company or a CC must calculate its public interest score at the end of each financial year. So the calculation of a public score is calculated as follows. So the criteria for calculating are as follows, as per the table below. So for the first one, it says the number of points. So for a number of points, it equals to the average number the employees of the company or a CC during the financial year. And then the second criteria of calculating this public interest score is that for every 1 million or portion thereof in the third-party liabilities of the company or a CC at the end, at the financial end, equals to 1 point. And for every 1 million or a portion thereof in turnover during the financial year, it equals to 1 point. And also, it's the third criteria of calculating the PI score is that for every 1 point, the FSP get 1 point for every individual who at the end of the financial year is known by the company or a CC. In the case of the profit company or a CC, to directly or indirectly have the beneficial interest in any of the company's issued securities, or in the case of a non-profit company or a CC, to be a member of the company or a member of an association that is a member of the company. So after you've completed your score, it also says there at the bottom the total public score. You also have to indicate the total public interest score as well at the bottom. So in terms of section 8.3, it will ask, does the companies or a CC have a public interest score of 350 or more? Then the FSP will have to indicate whether it has that public interest score or not. And of between 100 and 349, and its financial statement for the particular financial year were internally compiled. So the FSP will have to select what is appropriate for them, what is applicable to them. So it says if the answer to the above question is yes, then this exemption, it falls off as well, and it does no longer apply. So section 9, it also goes through about the compilation of financial statement. So the FSP will have to indicate whether the provider's financial statement were independently or internally compiled. So the FSP will indicate whether they are compiled or they're independently compiled and internally complied. So it says that in terms of the Companies Act, if the PIS of the provider is between 100 and 349, and the financial statement were internally complied, the financial statement must be audited. So section 10, it says the Companies Act exemption. This paragraph must only be completed by a provider that is a company. So 10.1 says, is the providers exempted under section 2A of the Companies Act from having its audited financial statement, from having audit or independent review its financial statement, then the FSP will have to select what is applicable to them. And then if the answer, it says that if the answer to the paragraph 10.1 is yes, then the provider, if the answer is yes, does the provider meet the requirement of the exemption referred in section 32A of the companies? Then they will select what is applicable to them. And then there's also a declaration at the end. It says that the declaration must be signed by the key individual of the provider, or in the case that the provider is the sole proprietor. So what I wanted to emphasize here is that sometimes when we receive this type of documents, when we analyze the financial statement, you'll find that the declaration is completed by the accountant or the accounting officer. So here it clearly states that it must be signed by the key individual of the FSP. And then there's a declaration there and then the FSP will have to sign and then date the document. Thank you so much, Akashin. Okay, thank you so much, Akashin. So on the screen, I'll be taking you through the calculation of a public interest score in terms of the phase notice 82 of 2015, which is the Annexure A. We have already highlighted the public interest score while we were going through the Annexure A. But however, the guide for calculating the interest score is as follows. So the number of point is equals to the average number of employees for the company or a CC during the financial year. And you also for every 1 million in the third-party liabilities of the company or a CC at the end of financial year equals to 1 point. And every 1 million, for every 1 million or a portion of in the turnover of the FSP during the financial year, it equals to 1 point. So there's also the 1 point for every individual who is at the end of the financial year of the FSP is known by the company or a CC. In the case of the profit company or a CC, to directly or indirectly have the beneficial ownership in any of the company issued in any of the company's issued securities, or in the case of a non-profit company or a CC, to be a member of the company or a member of an association that is a member of the company. And then the range of calculating there is as follows. So for every 10 cent to a million, the public score will equate to 1. From 1 million to 10 cent and to 2 million, then the public interest score will equals to 2. And for every 2 million and 10 cent to 3 million, it will equals to 3 and so forth. Thank you so much. I think we have come to the end of my slide. Thank you so much.
Thank you so much, Nobantu. I'm really happy that you touched on the public interest score. And we will now take a 5 minutes comfort break, 5 to 10 minutes comfort break. I think 10 minutes will do. So can we proceed at 10:55? And then we will just go through the final stretch of the slide, and then we will afford everyone an opportunity to ask questions and pose your suggestions. Thank you so much.
I actually answered it, but we actually in your balance sheet, we just look at all the liabilities that
It is now 10:55. I hope everyone took a break, grabbed a quick coffee because we are about to resume. I see that we have 3 hands, Johannes, Claude, and Anthony. We will give you an opportunity to ask questions. We just want to quickly go through the calculation of the public interest score and just give you a practical example. So can I just ask the people that raised their hand to be patient with us? We have noted your hands and we will give you an opportunity. So I'm just going to give Tandiwe Malefo an opportunity for her to take us through the public interest score. As I mentioned that there is a lag, so we are just currently going to project the actual example. Please bear with us. All right, I see it is coming up. Over to you, Tandiwe.
Good morning, everyone. We just wanted to tackle the practical example that everyone is asking for in the chat box. We just thought it would be prudent to at least just show you an illustration of what we mean when you have to complete this. What you would put on the 8.1 is basically the score that you would have worked out in this calculation in 8.2. You start by working it out. So it will say that it says here in the criteria. So it actually guides you in how you complete it. It says here in the criteria, and I know my colleague Nobantu just actually explained what the wording is. However, when we refer to the average number of employees, we're not saying everyone that you have employed in that year. You would have to average it out. For instance, if you have some temporary staff, in that work seasonally for campaigns or whatever at the beginning of a campaign, you would look at the number of months that that staff has worked and you analyze it. You analyze it to the number of people. So I'll make a practical example where you have 2 people who work for 6 months each in 1 year. That equates to 1 person in a year. So you would have those 2 people. You would have those 2 people divide by 12 times by 6 months. That gets you to the average number of employees. And you would then, in the basis of public interest score, you put the actual basis that you are relying on to give us the point. So a lot of FSPs, when they complete, they will put 34 in both. You need to say that you are referring to 34 employees. So you could say 34 permanent employees or 32 permanent employees and 2 seasonal employees. So you can actually break it down at that level as well as part of the notes. And then when we talk to 1 point for every 1 million, a portion thereof. So Nobantu has already explained what the portion thereof relates to. So anything between 10 cents and 1 million is the portion thereof of 1 million. So for instance, if you have 855,000 there, that is a portion that is looked at as a portion of 1 million. You would then put 1 point. If you had 1,855,000, that will then become 2 points because we count the first million and we count the portion thereof of the next million. Then you would put 2 points there. And then the same applies for the turnover. Oh, I just saw a question now that speaks to the third party liability. I will explain that. And then there is also 1 point for so the application is still the same. The 1 point portion thereof is, as I've explained it, the 1 point or portion thereof of the turnover during the financial year. So to that, we are referring to your revenue in your income statement, not necessarily your turnover in volumes if you're looking at number of products. So when we say turnover, we are saying the turnover that you have there on your commission statement or whatever the case may be. So whether it's sales or whether it's the figure that you have for your income, that's what we refer to as turnover. And when we refer to third-party liability, we mean the liabilities on your balance sheet, your known liabilities. So it will be your total liabilities less liabilities to members or directors or any related persons. So a third party is someone that is not a part of you. We are not referring to the third party risk, liability risk. We are not referring to that risk because there is no way that we can verify that the number that you put there is actually what covers your entire third party liability. So I hope that it clarifies that we are not referring to the risk that is covered in the PI cover, but the actual liabilities that you have, the known liabilities that you have. And when we refer to the people, so when we refer to the people at the end of the year who are linked to the FSP, whether in the capacity as shareholders, members, or directors, we mean anyone who has a right to receive a dividend, who has a right to receive a bonus as part of being part of the ownership, being part of the executive management of that FSP. So that's what we refer to, anyone who has a right to the shares and dividends of the FSP. So that is simply what is meant by this. So you will see there in the PI, in the basis, that we write there that is 5 members. So meaning if there is anything that is distributable, it will be split amongst these 5 members. So that's essentially what you are telling us, that in my FSP or in my entity, these are the number of people who have any rights to the distributable reserves. I hope that helps with the practical example that you needed. Thank you so much for your attention.
Sorry, Thandi, there's another question that has been posed on the link.
Thank you very much, Thandiwe. We really do appreciate your efforts in explaining the PI score. I hope everyone is happy with the practical example that we have just shared with everyone. I will now hand over to my colleague, Ms. Ziyanda Brukwe, who will take us on the final stretch of the presentation, and then we will take your questions and your suggestions. Thank you so much. Over to you, Ziyanda.
Okay, before I go, Zinhle, there's another question that has been posed on the link, on the chat box. In the chat box is there, regarding the Annexure A by Saskia.
Ziyanda, I think you are on mute. Can you kindly unmute yourself and take us through the presentation?
I have unmuted. I don't know if you can hear me. Akashan, could you please check?
Yes, Ziyanda, we can hear you. You can go ahead. Thank you.
Okay, before I go ahead, there's another question that has been posed. It's in the chat box regarding the PI score. It's from Saskia. I don't know if you can see it.
Ziyanda, we can see the question. We will tackle the questions after we are done with the presentation. Thank you.
Okay, no problem. Thanks. Okay, going on. Continuing with our financial soundness, the general requirement for all FSPs and juristic representatives is that assets must exceed liabilities at all times, not at some time or at some point in time, but at all times. And that the FSPs must maintain a financial resource that all the liabilities must be paid or must be met as they fall due, not after they fall due, as they fall due. So as we were mentioning before, that the point of having your financial statements or putting your financial statements together is so you can see the position of the FSP, the financial position, and you can see when you're not going to meet or you're not going to meet your financial obligations or as your liabilities as they fall due. So the FSP must ensure to maintain that all the resources of the financial statement or the resources of the FSP, the liabilities are met as they fall due. And the FSP may not become or continue to be an FSP or juristic representative if they've been declared insolvent or provisionally insolvent, if they've been placed under liquidation or provisional liquidation, or if they are subject to proceedings of insolvency or liquidation, or they seriously and persistently fail to manage financial obligations, and as I was mentioning before, or if they are under business rescue. So you cannot become, so your license won't, if it's your first time you're applying for a license, the license will not be granted. Or if you're already an FSP, you cannot continue to be an FSP if you have all these issues as an FSP. Thank you, Akasha. The next slide, please. Okay, now the next slide shows is an example of how we apply or how we do the solvency calculation. So we have a balance sheet of a ABC company here. It's it's comparative figures for 2019 year end and the 2020 year end. So if you're looking at the 2019, your FSP has got total assets of 15,000 and your total liabilities amount to 16,000. So the owner's equity are a negative 1,000. So financial soundness for this year was not met. So for 2020, the total assets are 25,000 and the total liabilities are 8,000 and financial owner's equity are 17,000. So the financial soundness requirements were met. So the FSP here is in contravention because we are saying at all times. So in 2019, they did not meet the financial soundness requirements. And in 2020, they met. So when we say at all times, we mean they should have met in 2019 and they should continuously meet in 2020 as well. And the reason we were saying that we need comparative figures is so that we can see the trend as well, that and the FSP, as they submit the financial statements, to see a trend as well that in the previous period, I did not meet financial soundness. And now in this period, I'm meeting. And for those FSPs who do not submit financial statements annually, as we require them to, or as they're required by the Act, so they don't see, they send them in the year 3. So now the trend is distorted. So now they can't see whether they are on point or they are doing things right. As 2019, they didn't meet. In 2020, they are meeting. In 2021, they don't meet. In 2022. So now this is a contravention of the FACE Act. Thank you, Akasha. The next slide. Okay, so now going back, talking into the previous slide, as we were saying that the specific requirement of financial soundness is that, for fit and proper requirement is that as an FSP that do not collect or as a representative is that all assets must exceed liabilities at all times. We always repeat this, at all times. So loans from related persons or entities that are subordinated may not be excluded from the definition of liabilities, what this means is this. If you're an FSP and you have loans, subordinated loans from related parties, be it a shareholder or a director or a related company, we don't take it into consideration. So we will not say your liability is less the subordinated loan. It does not, we don't take that into consideration. It will not be excluded from the liabilities. So the purpose of exclusion is to ensure that the FSP can meet its own obligations on its own. That as an FSP, your assets exceed your liabilities at all times, just as you, not with the help of the external funds that are extended to you. And this requirement is assessed on FSP to FSP basis. And FSPs are awarded an opportunity to do a remediation before we do any escalation. So what this means is this. As an FSP, you submitted your financial statements. and you don't meet financial soundness, and you advise the authority that I have members' loans that I'm subordinating. So because we do not take the members' loans into account, so that means now you still, your solvency cannot be restored. So now you asking the authority that, what can I do now? So we're saying as an opportunity, you need to provide us with a remediation plan to say, before we communicate with you, provide us with a remediation plan before we can escalate or take further action. So I'm going to explain how that works in the next slide. Thanks, Akasha. Thank you. So when we're talking remedial action, this is what we mean. An FSP is advised to submit the following alongside with the financial statements. So we said, as an FSP, you submitting the financial statements for 2022. You have 2021 comparative figures as well. So in 2021, you did meet your financial soundness. In 2022, you don't meet your financial soundness. And you can see as your financial statements have been finished, it's February 2022, you've signed off your financial statements and you're submitting them to the authority. And let's say the date is the 30th of June. Exactly on the 30th of June, you submitted your financial statements. As you see that your financial soundness requirements are not met, you're in the negative, your owner's equity is in the negative. What you need to do is to provide us with the copy of a management account right at the same time, at that time. The copy of management accounts will be from March, April, May, June, if you can do it as well. So it will be your 4 months management account statements. So if in those the 4 months financial management account statements, you still don't meet the financial soundness requirements. Let's say your February 2022 financial 28th February 2022 financial statements are showing a owner's equity of a negative 1 million. Now you've drafted your management account statements for the 4 months ending 30th June, and they're showing a owner's equity of the negative 200,000. So now you're submitting them together with the financial statements. And now you're providing us with a remedial plan, explaining that on the February, as of February 2022, I did not meet financial soundness. I'm in the red with my 1 million. But if you look at your management account statements, I'm in the red now, not 1 million, but with 200,000. This is the plan I have in place that will help me be solvent again. So in your remedial plan now you're giving me a remedial plan over and above the management accounts. So I mean, in your remedial plan, you're including the following. What is the strategy or initiatives that you will be focusing on in achieving your solvency now in your FSP? And how long will that take for you to reach or to meet financial soundness again? And you provide us now with income statement items that you'll be focusing on in order to increase your profitability, and thus you improve your owner's equity as well on the balance sheet. So what you're providing me is your 2022 financial statements that do not meet financial soundness, your management accounts for 4 months or 3 months that still don't meet your financial soundness, together with a plan that is explaining how will my operations improve so that I can meet financial soundness going forward. So on that plan, you're mentioning the time, you're mentioning how even the income statement items that I'll be increasing my sales, which I know will mean I have to employ more people. However, this is how much will be injected as the net in the owner's equity. You take that into consideration and you put it down so that as the authority, we can see a sound plan together with the financial statements that do not meet financial soundness. So this remedial action that has been tabled about must be implemented and be evident in the next financial statement submission. So if the authority now accepts that, okay, you don't meet financial soundness, and we've given us a plan that we feel it's sound, it makes sense, and it's doable, it's feasible for you to actually achieve solvency going into 2023. But now what we want to see is that when you give us the 2023 financial statements, they must show what you have told us on the plan. So when we look, that's why we're saying we'll take it on FSP to FSP basis, because not everyone will have the same problems, or not everyone will have the same plan. So, or even the solvency amounts will be different from FSP to FSP. So what we're talking about now is that come 2023, we noted your insolvency or your financial soundness issues from the 2022 financial statement and management accounts, and we've taken your plan into account. So now going into 2023, we want to see that has been taken into, that has been implemented, and the improvement is showing on the final financial statements. Failure which further communication will be done by the authority, or regulatory action will be taken, but that will have to be communication that is done between the authority and the FSP. Thank you, thank you. The next slide. Oh, yeah, that is the end of the slides. Thank you, Zinhle.
Thank you so much, Ziyanda. Thank you so much. We have reached the end of our presentation, and we will now afford you an opportunity to ask questions. And as I've noted before we went on our comfort break, we already had hands from Johannes, but I see that the hand is down. I don't know if Johannes, maybe you've been answered, or you will raise your hand again if you want us to give you an opportunity to ask your question. I will now hand over to Claude Rebi. Your mic has been enabled. Please unmute yourself, and the floor is yours.
Okay, thank you, presenter. Can you hear me? Am I audible? Can everybody hear me?
Yes, we can hear you.
Thank you. There was just one question that I have on that section, this Annexure A, where they say that certain companies that was registered under Section 30A or Section 30A2B does not need to have an audited financial statement. Who are those companies, and how are they constituted? That makes them compulsory to have audited financial statements or not? Thank you.
Thank you. Thank you very much for your question. Tandiwe is going to answer you.
Hi, Claude.
Thank you.
Hi, Claude. So the basic rule of Section 19 of the Phase Act says that all FSPs must have audited financial statements. Yeah. However, to relieve the financial burden of having audited financial statements on the smaller FSPs, the exemption for Annexure A was afforded to FSPs. And as my colleague went through the Annexure A to show you how. Sorry, we have a bit of an echo. We're just trying to see where it originates. Close your speaker. Okay, sorry about that. Okay, the feedback is gone now. So for you to actually know if you don't have to submit the audited financial statements, you need to go back to that Annexure A. It's a self-assessing exemption. So for any question that disqualifies you from moving forward on the form, it means that you are not eligible to submit non-audited financial statements. So if the Annexure A, if you take everything in the Annexure A and you are fine, you go through till the end, and there's nothing precluding you from applying the Annexure A, then you can submit an accounting officer report or any other kind of any other acceptable report other than an auditor's report. But if anything kicks you out on that Annexure A form on all the conditions, then you cannot apply. And automatically, as a FSP, if your PI score is above 350, you cannot submit unaudited financial statements, because obviously you you work with a lot more money than as you're not essentially a smaller FSP. And again, if it's above 100 and you have compiled the financials yourself, we need someone else, an external party, to verify the integrity of those financial statements. So if you have a PI score of more than 100, then it's more prudent that you have someone, an external party, compile the financial statements for you. I hope that answers your question.
Yeah, it's just that technicality on Section 32A of the Companies Act.
Okay.
Yeah. Under point number 10 on Annexure A.
Okay, so obviously as a company, you would need to go to, remember, and that's why we said in the beginning of the presentation that you need to adhere to all the rules of all the regulators that you are accountable to as an FSP. So as an FSP, you need to be aware of the sections of the Companies Act that pertain to you. So if you're a closed corporation, you need to be in compliance with the closed corporation requirements. If you're a company, you need to be in compliance with the Companies Act provisions. So you go into that section 30 of the Companies Act, you find out what it says, and then you make sure that you are compliant with that. Okay, sorry. So we just have, what does it say here? Okay, 32A. All right. So must be audited in case of a public company. So if you are a public company, then it will be audited. So it says there, if you answer yes and you are, a public company, then your financials have to be audited. You cannot submit an Annexure A. Sorry about that. Does that answer your question?
Thank you. Yes, thank you.
Yes. And a CC, even if you're a CC or a sole prop, if you're a public entity, then you cannot submit the Annexure A. Okay.
Thank you very much, Thandi. Claude, I hope we have answered your question. I see that we have our presenter, Ziyanda, who has raised her hand. She's joining us virtually, so I'm just going to give her an opportunity because I think that she wants to add on what Thandi has just said.
Yes, Zinhle, thank you. Just to add on to that, it says on the Companies Act that you could get an exemption. However, there are those terms and conditions you have to meet. So it depends who you are and what products do you hold, then you'll get that exemption. So as Thandi was saying, that you have to refer back to that part of the Act so that you know that you meet all of those before you can even get the exemption under the Companies Act.
Thank you very much, Ziyanda. We'll now give Anthony a chance to ask us a question. Your mic has been enabled. You can unmute and the floor is yours. Anthony, we have given you mic access. Please unmute and then ask your question. Okay, maybe Anthony has stepped away. We will give Victor Ndlovu a chance. We will enable your mic. Please unmute and the floor is yours.
Hi, everyone. My question is directed to Ziyanda. So yesterday I attended the first session. There was a very good example on how to calculate solvency, which was presented by Ishmael, if I remember correctly. Today's one's example is very much short. It does not give too much, a lot of details. But I've got a question with regard to, if you go to board notice 94 on the section 47, the definition of liquid assets. Yesterday's calculations indicated that the money market participatory interest in money market investment by the FSP is included at 100%. And my question was that, is that 100% based on one portfolio that the FSP has invested on, or is that and a collection of every portfolio, money market portfolio that the FSP has invested on. For example, if one FSP has invested in money market at Sanlam, Investec, Coronation, does that include all three money market funds in the calculations, or is that only for one portfolio?
Hi, Victor. So the
Hello.
question you are asking is not related to FSPs that are collecting premiums. So I think we are blending things that are not related. We are addressing the FSPs that do not collect or hold premiums in any form or shape. So the liquidity form will not be applicable in this instance. However, I would like to answer your question just to settle you there. So Ishmael did answer your question yesterday. And what he said was that you look at your investments in totality as an entity. So for instance, if you have investments or funds or portfolios in 10 different institutions, you look at the total value or the net present value of those portfolios. So you don't look at them per provider, and then you only include 100% of one provider. You include 100% of your entire portfolio as an FSP. And again, the same applies. The 70% is the 70% of your entire portfolio in collective schemes. But this is not applicable to this session.
Okay, but okay, I hear you that. But is this liquid asset calculations different for the FSP that hold assets and those that do not hold asset? Is that different?
That's what I said to you in the beginning, that liquidity does not apply to FSPs that do not hold premiums. Remember, because they do not collect any premiums, they would not have a separate account for the collection of premiums. Therefore, there is no requirement for them to meet any liquidity requirements. Because remember, what we are testing in the liquidity requirements for those who collect premiums is that they are not, they actually are able to meet all the premiums that are due to the product supplier. And that they are not, there's also segregation, they are not mixing the funds of the FSP with the premiums that belong to the supplier. So that's why there needs to be liquidity, because if they are not liquid, it means that they have more due to the product supplier than they have in the account itself, which indicates that some funds may have been used for bank charges and so forth, which is why the rules are there that say that if you're holding the separate accounts, you need to ensure that as the FSP, you transfer enough money for the bank accounts and service fees for that particular account, and that the client premiums are not used in any form or shape to cover any related expenses that are not okay, any, what do you call this? Any, I think I lost my train of thought here. Sorry about that. Does not cover, so the premiums should not be reduced by any expenses related to the FSP. And again, this also applies to FSPs that do not hold assets on behalf of clients. So it's very important that we separate the two.
So Thandi, thank you for that question.
Yes.
And the clarity. Will your answer be different if we speak about a K3 FSP that has got a nominee holding the assets on behalf of the clients? Will your answer be different then?
Okay, Victor, can I please refer this question, your particular extension, to the question to Shireen, and she will address it.
Good morning. Sorry, we just had that little lag before my mic was active. So remember in yesterday's session, we talked to FSPs who are collecting premiums or holding assets on behalf of clients. So Thandi's explanation just now also applies to Category 3 FSPs, because Category 3 FSPs are regarded as an FSP that holds assets on behalf of clients. So everything we've just explained about FSPs that collect premiums or hold assets on behalf of clients and the liquidity calculations that Ishmael went into quite a lot of detail in yesterday's session, That applies to category 3 FSPs. Today's session applies to category 1 FSPs that do not collect premiums or do not hold assets on behalf of clients. So automatically a category 2, a 2A or a 3 FSP is regarded as an FSP that holds assets on behalf of clients. So today's session does not apply to those categories of FSPs. Yesterday's session applies to those categories of FSPs. So if there's anyone in the audience who needs further clarification and assistance, we don't want to confuse matters in this discussion. Let's try to discuss today the FSPs that do not hold assets on behalf of clients or do not collect premiums. So that is primarily category 1 FSPs. We don't apply today's rules to category 2, 2A and 3 FSPs. So if you are a 2, 2A or 3 FSP, please contact us separately or drop us your contact details in the chat box, and we will gladly make sure that someone contacts you separately and have an individual conversation that is aimed at your specific situation.
Thank you so much, Charin.
Thank you very much for that, Shireen. Victor, thank you for your question. And we would also like to extend this invitation to everyone. We will be holding Q&A sessions. We will be sending out invites. Invites have been sent, so you can register so that if maybe you have a question related to an FSP that does not collect, which was held yesterday, then you can ask your question in our Q&A sessions that are coming up. So as Shireen has mentioned, today we are attending to FSPs that do not collect client funds. I will now hand over to, I can see that Anthony still has his hand up. I don't know if he's still here with us. Other than that, I will give Hlanganani Manzi an opportunity. Thank you. The floor is yours.
Good morning, everyone. I'm not sure if I'm audible.
Yes, you are audible. We can hear you. Thank you.
Okay. Can you just, on the same form, can you go down to 6.1, yeah? The question 6.1. Just for your clarity, all the PTY LTDs need to select yes on 6.1. Am I right? Because of Companies Act requiring that we must at least report the last section of this statement said, otherwise reported on. Am I right?
Hlanganani, you are correct.
Oh, okay. Thank you. Thank you.
All right. Thank you so much for your question. I will now hand over to Denise Pillay. Denise, you can unmute yourself and take the floor. Okay, maybe Denise has stepped away. We will give you an opportunity. So right now we will move over to Saskia. Apologies if I'm not pronouncing your name correctly. Saskia, the floor is yours.
Thank you very much. Yes, you pronounced my name 100%. And thanks very much for this very informative session. Just a very quick point for clarity on the public interest score calculation. Sorry, I keep harping on this, but the last aspect which relates to the, if you've got a company, the points for every individual who has a direct or indirect beneficial interest. I did pose that question and you kindly answered it. But in the answer, there was mention that it's everyone who has a financial interest in the FSP, including directors. And I just wanted to just clarify that. So with calculating that score, would we need to include the number of directors and then obviously the natural or legal shareholders in that calculation?
Saskia, we're just busy looking at the question. We will respond just now.
Thank you very much.
Saskia. Hi, sorry, you may have missed it. I responded to that in the chat. So if you see there, it says any person that is known to have any interest in the securities. So in the case of, so we are speaking to directors, members, and natural persons shareholders. But then in the case of legal person shareholders, you will then also look at the natural person shareholders of that legal person shareholder. I hope it is clear.
Yes, no, thanks. I saw that answer. I was just wanting to clarify that it definitely includes the directors as well. Sorry, I'm maybe just missing it.
Yes,
okay, so we would calculate the number of directors as well
in
as
that,
the shareholders. Okay.
Yes, so all the natural persons in the shareholder that have any interest in the shareholder company, if that makes sense.
Yeah, no, that makes sense.
Thank you. Right.
Thank you very much, Sandiwe, and thank you so much, Saskia. I'm going to give Denise the last opportunity for her to raise a question. If not, I will hand over to Leonardo. Leonardo, you can unmute yourself and take the floor. Denise or Leonardo, are you still with us? If not, I do not have any more hands. And that means we have come to the end of our presentation. I'm just going to allow you 2 minutes just to think if maybe there is something that you want to ask. Okay, I see here that there is a hand. There isn't a name, it's just guest. So we will give you mic access, unmute yourself and take the floor.
Thank you very much. My name is Leon. I would like to know what is meant by third-party liability in question 8.2.
Hi, Leon. Okay, so what we refer to when we speak about third-party liability in that public score calculation is the actual liabilities that are not due to related persons. So if in your balance sheet you have liabilities of 1 million and 200,000 of that is related to perhaps a director, a member, or any other associated person, you will minus that 200,000, then you are left with 800,000 of third-party liability, so meaning someone who is not related to the entity. So when we refer to third-party liability here, it's in the general sense, not the third-party liability risk that you are actually covered for in the PI cover. So I know there's a bit of misinterpretation there that some most FSPs will think that it's the risk that they are covered for. Does that clarify your question? Leon?
Hello, yes, thank you very much. Appreciate it.
Thank you.
Thank you. Bye.
Thank you so much, Sandiwe. Leonardo, I see here that you are saying you cannot unmute your mic. Can you please type your question and then we will answer you?
I managed to do it now. It wasn't working somehow. I'm not sure. Thank you for your presentation today. It's very informative. I've been in and out a bit, so I don't know if it's been dealt with and if this is the right place, because I see there's a session on the 26th where somebody has raised the question. It's more of a philosophical one about the reason or the rationale of why FSPs that don't hold client funds or collect premium are held to a higher standard in terms of the exclusion of subordinated loans from related parties and so forth. is this something I should ask next week, or is it something that you could possibly shed some light on now?
Thank you so much for your question, Leonardo. I will hand over to Shireen, who will answer you.
Hi, Leonardo, and I think Claudia asked the same question in the chat box.
Yes.
So just on the subordination, the reason why it's excluded from the calculation of assets, remember for FSPs that don't collect or don't hold assets on behalf of clients, our only requirement for them in terms of financial soundness is that assets must exceed liabilities. So it's literally a calculation, and I know it's not always an easy, but that's what it boils down to. It's what are your assets, what are your liabilities? Subtract your liabilities from your assets. So what he did is in the work that was done on the determination of it's improper during 2015 to 2017, when we were drafting the amendments and having the consultation about the amendments, was we had a lot of requests from people in the industry saying that there was a disparity between our financial soundness requirements and the financial soundness requirements in terms of the Companies Act. And there was a lot of requests for us to align it to make it easier for FSPs to adhere to both of the requirements. So in the Companies Act, the calculation of assets over liabilities do not exclude subordinated loans, but it does include the calculation of goodwill and in the calculation of assets. And that is why previously we excluded the calculation of goodwill from the calculation of assets. But when we calculated liabilities, we allowed FSPs to subtract the subordinated loans from the calculation of liabilities when we then said, what are your assets versus your liabilities? But to align it to the Companies Act requirements, we then included goodwill under the calculation of assets and excluded subordinated loans from the calculation of loans. And that was really the alignment, and that was the reason for that calculation. However, we do understand that the way that FSPs come to existence is by injecting their own money or money from friends or family or otherwise known as investors into the startup business. And it takes a while to rectify that situation. So if this is your situation as an FSP, that you still have or have to start up with subordinated loans on your balance sheet, and it's going to create, I'm not an accountant, so if I use non-accounting terms, just bear with me. But if this creates a disparity in your calculations, in your situation, please contact us. We really would like to speak to you. Don't wait for us to pick this up on your financial statement. Be proactive. Every FSP has a dedicated analyst assigned to you, a portfolio manager, and contact your portfolio analyst and say, this is my situation. What can we do? And we will then walk the journey with you. We will look at your situation, as Ziyanda explained, to the remedial action that we can consider earlier. We really are looking at remedial action. And if it takes a couple of years, let us figure out with you how many years, what are the reasonable actions that you can take. And if needed, we'll help you to formulate an exemption application and formalize this. But we need to do this on a case-by-case basis because your situation could be different to the next situation. Leonardo, I happen to know that you are a compliance officer. You have different clients. If you look at the FSPs who are your clients, you will see that their financial situation would be very different from a case-to-case basis. And that's what we look at. We don't deal with this on a general basis. And I keep on saying this in different words, but bottom line is, talk to us and we'll help you.
Shireen, thank you very much. I think that approach is really, really helpful, especially for startups. And I think what I was missing, you explained quite nicely, and that was that the inclusion of goodwill in the calculation of assets. And I think that then makes sense for me in terms of that. So thank you so much for your answer. It clears up a lot for me.
It's a great pleasure, Leonardo, and really to you and to everyone else, we're not that scary. You can talk to us.
Thank you.
Thanks.
Thank you.
Thank you very much, Shireen, and thank you very much, Leonardo. And I would like to stress that as the regulator, we are really not scary. we are trying to work with each and every FSP. That is why each and every FSP has a dedicated analyst. I see that Denise still has her hand up, and guest, there isn't a name. I think we've given you an opportunity. So I'm going to move over to Richard. Richard, the floor is yours.
Hello, morning everyone. Yeah, my question is not actually a question. It's an issue that we all went through. In the past 2 years, since the pandemic, we were not submitting financial reports. I think we all know that, but we are only required to pay the levies. So now, when you're talking about financial soundness, I mean, it's obviously everything. Most of everything was closed from businesses. So now that much of everything is open, I mean, I think most of us will be having a backlog on coming to be financial soundness because of business was not operating economically in that sense. So we want to know, how are we gonna to be soundness, or maybe are we gonna start afresh because we're only paying the levies, but we're not submitting the financial soundness. So now most of us will end up just writing just to be financial soundness in the face, but then not in the actual sense. So we want to know, I mean, how are we gonna deal about it, because of it's an issue to everyone. Since the pandemic and after the pandemic, life is different from what we used to know. So how are you gonna deal about it? Since yes, I think my question is clear.
Richard, thank you so much for your question. I will hand over to Shireen, who will answer you.
Hi, Richard. Yeah, we know that the last 2 years has been very challenging from a number of perspectives, and that's actually going to be part of what we are asking you for feedback on in the financial soundness survey that is also alluded to in the chat function, and we have that workshop on the 26th, and we'll be talking about the survey. But on your very practical question, so we gave people during 2020, when we went into that very, very hard lockdown that extended for much longer than anyone thought it would. We went into phase 5 and then phase 4, and it was really quite a challenge for everyone in South Africa. So to acknowledge the fact that it happened quickly and we couldn't always prepare and put things in place, we gave additional time for the submission of your financial statements, but we didn't exempt you from submitting it. We just gave additional time for the submission of the financial statement. And one of the things that we are busy doing is we are busy catching up with all of the FSPs who have not been submitting their financial statement. We've been contacting them on an individual basis and saying, please rectify this because we need your financial statement. And if you don't submit it, then unfortunately, we are going to take regulatory action, and regulatory action is not nice. We want to avoid that. So first of all, please, please, please urgently contact us so that we can arrange with you when are you going to be submitting your financial statement. And this is a matter of urgency. So to you and to anyone else listening today who's in the same boat, you need to contact us as soon as possible. By next week, as fast as you can. Get hold of us, let's talk about this, let's rectify. So that's the first thing, get your financial statements to us. The second thing is, if on your financial statement, it's going to show that you do not meet our financial soundness requirements. In that very same conversation, speak to your analyst. Remember, I've just said every FSP has a dedicated analyst. This is the chance to become best friends with your analyst. You're going to be speaking to your analyst on a regular basis, and we are going to understand your business. We are going to unpack your financial situation with you. We're going to be very intrusive here. So let me just warn you upfront. We're going to be asking you difficult questions, and you're going to have to give us very honest answers so that we understand what the situation is, how big is the problem, so that we can work with you on a remediation plan. I hope this helps.
Okay, no, thanks. I just thought in this session, we've been submitting our financials every year before 2019 and before. So in this session, we just I don't know. I'm just saying because I'm hearing it's the same thing that we've been doing a long time ago. I don't actually hear something or maybe learn something new. It's just that maybe it's a question of me not understanding. But we've been doing this, submitting this, and then in submitting the levies and financial balance sheet and whatever. That is sound. So basically, this session is just to highlight or maybe to remind us what we've been doing all the time. I don't know if you get me.
So Richard, if that is the situation that you're not hearing anything new, you understand what to do, then this is the refresher and just making sure that you are still on the right track. When we send the invitations, we don't know what your level of understanding is. And we base our content on the questions and the conversations that we have. Because remember, there's about 11,600 FSPs. We have a lot of conversations on a regular basis. So when we compile our content and our invitations, we base it on the general nature of the queries that we get. So for you, this might not be new, but there might be someone else sitting in the same venue, well, the same session, not the same venue, but the same session going like, oh, I didn't understand this, and just explain it to us. So great that you understand it, and I hope that we help someone else maybe with something that they didn't understand.
Okay. The last question. Is there any CPD points here?
Unfortunately not, Richard. We really tried to get this accredited for CPD purposes, but we couldn't. But we are hoping that by next year, we'll have our events registered for CPD again. The moment it's registered for CPD, we will let you know.
Is this not a training?
It is training, but it's not accredited for CPD.
Yeah, no, okay, it's fine. Thank you.
Thank you, Richard. I think while I have the microphone, shall we move on to the next person, which is Kadia? Kadia, you should be able to unmute.
Shireen.
Yes, Kadia.
So my question relates to juristic representatives. What is the reason that a juristic representative is a company? I understand that, but if there's a subordinate loan in a juristic rep's calculation, it's normally the FSP that granted the loan. So why does an FSP and a juristic rep have the same calculation requirements if the risk is lower, if the FSP is financially sound? Oh, apparently one of my colleagues says it's been already asked. I might have missed that. So my apologies, but can you answer me again?
Look at what the answer was before I inadvertently give a different answer to what my colleague gave. Can I just check for 2 seconds? Hold on for me.
Yeah, sure.
Kadia, I can't find the answer.
Oh, no, then apparently my colleague is also not completely with us.
Okay, but so let's go. And if I inadvertently do not have the same responses to what a colleague of mine has given, then let me give you my interpretation. So on a juristic representative, remember in the situation where a juristic entity is appointed as a representative of an FSP, that juristic entity essentially becomes, for the purposes of phase, an extension of the FSP. So we hold the juristic entity then to the same level of soundness requirements that would apply to the FSP. So if the FSP does not collect it means that the juristic entity for the purposes of that appointment can also not collect premiums. So the same requirements that applies to an FSP that does not collect premiums or hold assets would then apply to the juristic entity for that appointment. So we have juristic entities that are sometimes appointed as representatives, juristic representatives of multiple FSPs. So this could end up like a box of Smarties. It's very confusing color-wise. So the juristic entity will then have to apply for the purposes of a specific appointment. And I'm just doing here, and you can't see me, but just, see me pointing now, that if you are the juristic representative of FSP A, then you have to adhere to the same requirements, solvency-wise, as FSP A. If that FSP does not collect, then that's the requirement that applies to that juristic entity. If the juristic entity is appointed for as the juristic representative of FSP 2, and FSP 2 is an FSP that either collects premiums or holds assets, then the soundness requirement that applies to FSP 2 as an FSP that collects premiums or holds assets would also apply to the juristic representative for that appointment. And that's how you unpack this. So the same would apply if the juristic representative is appointed as the juristic representative of a category 2, a 2A, or a 3 FSP. In that instance, the liquidity calculations where we now look at current assets exceed current liabilities, as well as the liquidity, and in some instances, then holding a certain amount of assets separately, would apply to that juristic representative as well. And then we also have the added requirement where the juristic representative must submit their financials to the FSP that appointed them on a biannual basis, so every 6 months. So remember, the juristic representative extends the risk of the FSP. So the FSP must now not only look at their own financial soundness and the risk that it carries as a result of that, but it must also look at the extended risk that the appointment of the juristic representative brings to it. If the juristic representative gets into financial trouble, does this enhance the risk that the FSP is facing? I have alluded to this previously very loosely as the license to meddle, because the moment that a juristic representative is appointed, the FSP must go and take a very close look, not only pre-appointment as part of the due diligence, but also on an ongoing basis. What is going on in that juristic representative, and what is the risk that the juristic representative's activities hold for the FSP? Katja, I hope that has helped you.
It's not the answer I'm looking for, but it explains it.
Unfortunately, we won't always give you the answer that you want, but we will give you the honest answer.
Okay, so also, although the FSP is responsible for the juristic rep, you still have to apply to the FSCA if they're not financially sound. You can't manage them yourself.
Yes, you have to apply to us.
Okay.
Because Katja, on your balance sheet, you may be financially sound if you're the FSP. But because we don't see the financials of the juristic rep, the financials are seen by the FSP. We don't know that your risk is actually grown. Because by taking on that juristic representative as your representative, you have exponentially expanded your risk, but we don't see that. So if you don't notify us as a result of your own ongoing monitoring, we are not going to manage the risk that you now pose not only to your clients, but depending on the size of the entity, this could become a systemic risk for the industry, and we won't know it. So we rely on you as our first gatekeeper, but you have to have that conversation with us as quickly as possible and as honestly as possible.
Okay. Thank you.
Pleasure.
Thank you very much, Kalia. Thank you so much, Shireen. I do not have any more hands. I hope we have answered everyone's question. I would like to take this opportunity to let everyone know that the FSCA will be holding Q&A session in different languages. So on the 19th of September, we'll be having a Q&A session in Afrikaans. If you would like to join us, please register. We already have about 200 people who have registered. So we will be taking your questions in different languages. So on the 19th, it's going to be Afrikaans from 9:30 till 11 o'clock. And then on the same day, we will be having isiNdebele, isiSwati, isiXhosa, isiZulu. This will be on the 19th of September, as I mentioned, from 12 o'clock till 1:30. And then on the 20th of September, we'll be hosting Setswana, Sesotho, Sesotho Leboa from 9 o'clock till 10:30. And then on the 20th, which is the same day, from 11:30 till 1 o'clock, we will be hosting Xitsonga and Chivenda. So I would really encourage people to join this session so that you can be comfortable in asking us questions in your language that you prefer, so that you can be comfortable and that we can also give you an answer that you will clearly understand. I will also like to reiterate that we will be having a financial soundness survey workshop. I'm going to encourage everyone to also join. This will be held on the 26th of September from 10 o'clock till 11:30. So please do register, because the financial soundness survey, it's a totally different context that we'll be presenting. So I'm going to encourage everyone to join. With that being said, this brings us to our end of the workshop. Thank you for making this session an interactive and insightful one through your interactive participation. It is a gift to be able to receive and give feedback wherever possible. We hope that you will leave this session feeling more empowered on your legislative requirements and the purpose behind these. And I would also like to stress that please be in contact with your analyst, and we will be more than happy to advise you and give you more information on whatever that you need. Thank you very much. We wish you all the best in your endeavors. Goodbye, everyone.